first and foremost, my name is Tyson Ray, and I'm one of the founding partners here at Form Wealth, representing one of the three of us as the partners of the firm, although there's about 20 of us now here in total. These thoughts that we have and some of this information that we're sharing with you is coming from multiple sources, one of which is Raymond James, but these aren't their opinions, they're ours. And so a little disclosure there for our presentation. This deck of information will be available if you would like to reach out to us afterwards. And also we're going to be putting this out on to others that aren't able to attend today. So with that, I'm going to go over a couple different things. Let's start with kind of what are some of the hot topics that people are talking about with regards to the economy. And again, one of them obviously is inflation. And so this is a chart going back for the last couple of years on inflation. And what I want to draw everyone's attention to, and actually as of yesterday, the Federal Reserve, who really has a lot to say about inflation and the interest rates that they're raising and how they're worried about inflation. They basically feel that, get my little clicker here and get my color right. They basically feel that inflation is not coming back to that 2% level till about 2025. And part of that is it's just taken so long for the markets to basically go up in this last year and a half to get to a peak. It's probably going to take about, there's an old saying that the amount of time it takes to make the change is about the time it takes for the change to fix itself when it comes to the economy. So it's been about a year and a half in the making, all part of the run-up of COVID. And we think it's going to be about another year here before we're going to be done. They think we'll be back to this 2% level, or inflation will be back to normal, a normal growth rate. What everybody seems to forget, though, is that inflation tends to compound, meaning inflation went up and inflation's coming down, but it's the growth of the inflation. So the cost of what we're buying our budgets don't necessarily all of a sudden get to be made whole for the increase in prices. It's just the prices don't keep increasing. It's the compounding effect of inflation over time that eats away purchasing power. And we wanted to get this 10% compounding from, we didn't want this 10%, I should say, to compound. We'd be better if we compounded at lower rates for longer. So we got some more time yet and some more uncertainty with regards to inflation. And there's some people that are and I'm one of them, that are thinking it may be a little harder to get back down to the normal just because of the magnitude of what the stimulus was that they injected into the economy because of COVID. There's been a lot of talk about recessions, and I just thought I'd throw up a recession slide. For one thing, we'll probably end up having one, but it's probably going to take longer than we think, and it'll probably happen faster once it happens than we think. But historically speaking, they tend to last less than a year. And in fact, if we go back to the 70s where we had inflation-induced recessions, the recession itself, again, didn't last all that long. And we're not expecting that to be the case here either. And we may not end up having one. What's driving the market is the fact that companies are still making a lot of money, and the earnings are continued to project to grow. However, this concern of concern of inflation and concern of a slowdown, it's when you have time in the past where in the financial crisis you had a couple of years where companies made less money. And if you think about it, if the market or investments are driven by the value of what these companies represent, how much money or profits these companies make has a lot to say about what those companies should be valued at. And if every year over year the company is making less money, then the company probably shouldn't be growing in price or being worth more if it's making less. And so this is a reflection of the 500 largest companies of the S&P 500. And it represents what normally is referred to as the market. And so the financial crisis, you saw it come down and then come back up. It took a while. COVID, we again had a downturn, and now we've come back to the overall kind of trend, but we started going sideways here. And that's a reflection of the Fed starting to raise rates. And the concern is, do we dip back down, which again means these companies shouldn't be justifying these higher valuations. Or are we going to keep growing or go sideways? And that's what will remain to be seen. But again, over time, they tend to grow over time. They just are volatile year to year. And we're just sitting here thinking that for probably the next 6 months or so, what happens to earnings is going to have a lot to say with the direction of the overall market. Want to talk about our government. This slide, I'm sorry, has got a lot of information on it. So I'm going to draw your attention to it a little here as I figured out how to use this. So if I just drew your attention here to this part, so this is the federal budget or their and kind of what they're borrowing every year. They're spending about $6 trillion and they are borrowing about $1.4 trillion a year. And notice that as far as their spending goes, when you take out Social Security and Medicare, you're almost at 50%. When you add defense, you're over 50%. And so unless they want to cut defense, unless they want to cut Social Security or Medicare, you really are going to have a hard time fixing the budget. The rest of this is special interest stuff, and some of it's necessary, obviously, but a lot of it doesn't put a dent in what the overall deficit or budgets are. It's depending on how you look at it. If we look at the federal government's budget and deficits based on their cash flow or what they're spending, it's historically coming back into, it's on the higher end of what the outlays normally were. Again, you had both a financial crisis and then COVID back to back that caused some of this higher national debt. And as a percentage of GDP or a percentage basis, we haven't been this high. And in fact, we're higher than we were during World War II. And the difference is when the war stopped back in World War II, the cost of the war stopped. And so you had a dramatic correction in the national debt, and eventually it got paid off. We're not seeing that coming out of the financial crisis, which was the spike that we originally saw here. Let me get that up here. So the spike that we saw here in the financial crisis didn't correct, and then COVID compounded it, and we've compounded since then. And that's some of the concern. The national debt right now is forecasted about a little over $30 trillion, which is about 6 times what the spending is, or excuse me, 5 times what the spending is. And that's concerning. And yet, remember that $30 trillion number. Now we're focusing on the US consumer balance sheet. So this is our population. And we're touching again on record levels where the population has about $160 trillion of assets, $168 trillion of assets to about 19, let's call it $20 million of liabilities. And in fact, if you netted these two things out, the net worth of the average consumer, if we rounded it off, would be about 150 trillion. Those are big numbers, but just remember what I said earlier is the federal government's debt is about 30 trillion, and our consumers, our citizens' net worth is about 150 trillion. And so we have the assets if we wanted to pay off our national debt to do so, and we choose not to up to this point. And we may elect officials to choose to do that, and they would tax it away from us, or they would slow down the growth to slow down effectively our national debt has allowed our citizens to accumulate a lot of wealth that they have to pay off the national debt if they wanted to. The problem in this world is when you have governments that owe more money than their actual citizens have of assets to pay off, that would be a problem. Otherwise, we're continuing to elect officials to provide resources and run budgets that run deficits to create the standard of living that we want for our country, and then gives incentives for others to go and build the type of wealth we're seeing. Just for fun, one of the hot topics in politics is student debt. I'll draw attention to, again, how low overall debt is for the average consumer, and that student loan debt specifically is 9%. I mean, it doesn't even really, it's hard to even see at this level that one of these little lines right here is student debt. It's insignificant in the grand scheme of things. However, for those that have been enjoying not having to pay their student debt, you have this very low, and in fact, usually student loan debt has some of the highest delinquency rates. And because since COVID, they haven't had to make any of their payments, although that's changing here going forward, they've enjoyed not having to pay those payments, and we have very low delinquencies. The concern is what's going to happen as the payments have to start kicking in. The last thing I'll point out on this slide on the consumer finances is how low interest rates coming out of COVID have reduced overall household debt service. And for one thing, it was because we didn't, we had no place to spend our money, so we were paying down our debts with the cash that we had in COVID. Coming out of COVID, we're historically at these lower levels, partially because we had really low interest rates on mortgages and credit cards. But the concern going forward is that's going to start creeping back up as houses are buying mortgages now at 7% instead of the 3% that we had been at. Overall, though, for those that are worried about our government and the economy from a government perspective, they forget to put the compared to what. If you look at the consumer's finances, the average American citizens, or all of us put together, we're in some of the best shape we've ever been. That's showing up again in different economic data with regards to whether it's shopping. And again, we couldn't spend any money in COVID here, so retail sales dropped off. It spiked again once we could. It's now coming back down to normal. This spike was also part of what drove overall inflation. If I jump here to the personal savings rate. So this is again where you see a spike where in COVID we had nothing, we couldn't spend our money on anything. So therefore you had this run up. I can't do that. You had this run up in personal savings, and then we had that second spike over that Christmas, if you remember. But overall, personal savings rates have dropped back down as both the stimulus has stopped, people are going back to work, the inflation of things costing more, and the fact that once you save this money in your bank account, it builds up. Now we're spending that back down, which means we're not saving more, because again, these are percentages that grow year over year. And so we may run negative here for a little while, just to bring that excess back out of the system as it's been in. Anything else? Oh, this is the other example I wanted to show you. Just again, household debt service ratios are some of the lowest they've been in years, well below the 20-year average. And so again, that's giving, because we're not spending a lot on our debt, we can spend more on these other items that have gone up in price with inflation. As an overall economy, this slide is reflecting, again, the growth of the country, or of the gross domestic product, or an overall reflection of how the economy's been growing. It had been growing at about a 2% trend rate until COVID came along. COVID had us have, again, where we shut down our economy. We probably won't make that mistake again in the future. We turned it back on, and it basically come back up in line. We've dipped back down here with inflation coming back on and the higher interest rates, although this most recent quarter projected again about a 2.6% growth rate for GDP. That U.S. economy is driven partially by, again, housing, partially by just investments in general. Again, some of the government spending, but the vast majority of our economy is our own citizens consuming products and services that people are providing. And again, as that consumer is in a pretty powerful position, that's going to bode well for our economy. So I want to talk a little bit or shift a little bit about kind of some investment principles and kind of some things that we're thinking about. We have been for a while and plan to continue to stay overweighted to the equity space, barring depending on how these interest rates play out. And part of the reason why is that for the last 20 years, the difference between having a conservative portfolio, which is up here, and having an aggressive portfolio, which is down here, it's not showing it. Let's try this again. So conservative up here versus aggressive down here. The difference between these is often how much exposure you have to stocks relative to bonds. And the more conservative, obviously, the more you have to fixed income, cash, bonds, and the more aggressive you would have to the growth of equities. And it used to be, or the textbook says, hey, the more exposure you have to fixed income, the more likely your portfolio will cushion the downturns, or will protect you from the downturns. And day in, day out, that may be true, but when you actually get into longer periods of time, or snapshots in time, in this case, calendar years, it actually, in some cases, starts working against you. And I highlighted the three that I want to show you here. So in the financial crisis of 2008, notice that there's a pretty big difference between 10% loss and a 28% loss, but no one likes loss, period. However, notice the recovery up 21 versus up 12, just that recovery, you made up that difference. If I go back to 2018 and 2022, and I think this is more likely going to be the trend going forward, in 2018, you were down 2% in your fixed income for the portfolio, and you were down 3%. So the bonds didn't necessarily cushion this loss. Again, in the financial or in COVID, down 14 and down 16 to me is about the same. And so this idea of here having more bonds in a portfolio is going to give you more of a cushion. I think some of the reason that's not showing up is because nowadays when people are panicking in their portfolio, they still have the ability to click their mouse and sell everything. And that includes selling their fixed income or selling their bond allocation, which brings the same volatility that's not supposed to be there. If you were really paying attention, you would go in and just sell your exposure to the equity market and you may keep your bond portfolio. But the average person with their wealth, the vast majority of their wealth in a 401k is just taking a mouse and clicking sell all. And that's bringing more volatility, I think, to the fixed income space that's reflected in these 2 years. And that volatility, however, over time, or the recovery over time, is that the difference with the same money invested is the difference between about a $300,000 return over 20 years versus almost a $460,000 return. The volatility actually gives you the reward over time. And so some people are being overly conservative, and in doing so, trapping themselves from being able to allow their wealth to grow, because in the years that the markets did well, they substantially do better than the fixed income. And my concern is that if the fixed income is going to do poorly with the equity markets, but not grow when the equity markets are growing, why have so much exposure to it? Which is why we've remained overweighted for our clients of the equities. One of the drags on our portfolio and just the markets in general in the past couple of years has been international. In fact, usually the US outperforms the international markets, and then the international markets outperform the US. And what we're seeing here is that the US here has dramatically outperformed both the international and emerging markets or developed markets for the last several years. And that's a pretty decent gap. However, in the last few months, you can see that revenue-wise, the developed markets have grown and the US markets have trailed back down. And so we might be experiencing a trend. And in fact, this inflation environment, rising interest rate environment, this shift that we've had in the last year may be the catalyst that may cause the rest of the world to play a little catch up. And we have our portfolios kind of allocated to benefit from that, where for the last couple of years where we've been wanting that to play, expecting that to come along, it's held some of our performance back. I think the other thing is, because this is a perspective that we want to bring to clients and to investors in general, I want to remind clients just kind of a little history of the market. And in the market, which again is the 500 largest companies, are traded based on really people's emotions. So all of us are deciding what any one of these companies, or what the market in general is pricing each day, values at. And what tends to happen is people get really excited and tend to move in mass when the markets are going up and the trend is your friend, and you maybe decide to get in, you're excited, and that builds the confidence because I've been right and look at what my investments have done, and then it's euphoric, like this is the only place to be. And the most amount of money often comes into the investments in this euphoric confidence state. What tends to happen is fundamentals tend to show up, and if companies get overvalued, eventually that will correct itself more often than not. And as soon as these investments turn over, it doesn't take very long for my confidence or my euphoria to turn to nervousness, to fear, and then eventually till I can't take it anymore. And more people tend to sell down here. And again, the old buy low, sell high means you're buying when everyone's panicking and you're selling when everyone's euphoric. And effectively, that's my job security for the rest of my career and the future of financial advice, is to protect people from their emotions, from feeling like they're confident and euphoric and getting ahead of themselves, and realizing a lot of times the best time to buy is when everybody's panicking. And I'm going to show you how this plays out in the markets over time. So over time, here is basically the last 20 years of large cap companies, small cap companies, emerging markets, developed markets, and cash. Obviously, there's not that much fluctuation in cash from a return standpoint. But what this is showing is that if I use large cap stocks for any 1 year in the last 20 years, the lowest 1 year return was your portfolio went down, you panicked and sold, or a lot of people did, that drove prices down by over 40%. And yet the euphoria of the market doing well, at the same time, it drove prices up 56%. And so if you were watching or getting caught up in any 1 year of the market, that was the extreme swing of the goalpost, if you will, of the 20-year time frame. And yet if you went to sleep and woke up 20 years later, though this happened, you both lost 40% at one point and went up 50+% at one point. You averaged about 10. Notice that for small caps, you had a higher high and a lower low, but very similar, but again, the same average about. Emerging markets, a little bit less return, a little bit more to the downside, a little bit less to the upside, and the same for develops. But the point is, huge swings in any 1 year. And this is why you can't take money that you need to spend in 6 to 12 or 24 months from now and invest it in the market, because you have too much of a chance of having a down year and not enough time to make up for it. But if you have money, as many people need, that you're going to need 20 years from now, or you're going to need to pass on to loved ones, or you need to set aside for retirement, if you have a longer term time horizon, you actually can't panic out of these markets, because you lose this 10% average that people get, only to the extent that they stay in. If I laid it out differently, now this is just your large cap stocks, here it's a different study, but the same idea is that your average return is again above that 10% level over the 20-year time horizon. However, since the 1950s, your rolling 20-year time horizon, your worst 20-year time horizon, or your worst 20-year return, going back to 1950, was 6%, and your best compounded 20-year return was 17%. And again, the average is about in the middle. For the clients that can't stand the volatility of the market in the short term, because in any 1 year for the last 20, or going back to 1950, was down about 40% and up about 47%. So that's just, this is the gambling, this is the swing that everybody gets worried about. Notice when you go from 1 year to 5 year, the bottom almost goes completely away. Same thing on the 10-year time horizon. And actually there's no rolling 20-year period since 1950 where there was a negative return. And so it means you only create a negative return in your portfolio if, to the extent, at least historically speaking, you had to panic out of it to make it permanent. And our job is to try and prevent that with this type of perspective. If you go back to the Great Depression, again, the average return of the market falls in this 10% range, and yet the calendar years themselves fall in extremes. And the downside that everybody's worried about actually is quite rare. It happens, but basically this is saying about 75% of the time, rounded off, you're going to have a positive return, and that positive return is pretty significant. And what you'll also find is that the more the market has been down, the preceding year, the market has come back quite a bit, which is to say that, if we go back here, that 2008, the market was down 37. If I go over here, 2009, the market was, where did it go? Up 26. And so the down tends to all of a sudden cause the up, and at the same time, you have up years that could cause down years, and that's the fluctuation of markets coming back into line with fundamentals. It's fear and greed driving people's emotions, but over long term, those fundamentals show back up and compound wealth quite well. I'm going to show that a couple different ways. This is another way of looking at this. This is showing the inner year. So where in the past it was showing an annual return, this is now showing that in COVID, for example, the market dropped 34% in 30 days, that first quarter of 20, and yet ended the year up 16%. No one was expecting that. Here in the correction of 2022, the market actually dropped 25% in October of 2022, but then recovered. So the market finished down about 19. And what clients' emotions or what clients feel is this way of looking at the market, which is that every year the market's down from some previous high. And they want to come and say, I've lost. Well, no, you've probably just had some profits fluctuate in value if you've been investing for a long period of time. And actually, the power behind this slide is for those that aren't retired and people that are dollar cost averaging, you maximize your returns by taking advantage of all these downturns, because if every month in the calendar year you can be adding money, it gives you opportunities to buy when these little panic sell-offs happen, and they happen regularly. And we just need to help you ignore them by making sure you don't have any money that you need invested in a market that can fluctuate like this. As an advisor, I try and bring perspective that, okay, going back to 1980, there's only been a few actual calendar down years, and there's been a lot more up years. And it's this wealth opportunity that people miss when they get too focused on this. Let's see here. Another way of looking this over history is just the market goes up a lot more. It's the 5 steps forward, 2 steps back. And this lays out in ways of showing the downturns have been severe in the past, but the upturns have been even more so. The other thing I'm reminding myself these days is where the market corrected 25% and now we've gone up 24%. Markets have a tendency to go up and then correct off of the new profits, not go up and then go down and go up and go down, and you actually just go sideways. And so this is a reflection of, again, of how the market since the Great Depression has basically been in this long-term uptrend. And there was a period in the 70s where we went sideways for about a decade. There was a period between the tech bubble and the financial crisis that caused what they called the lost decade. We've had another advance here. We've gone sideways a little bit. They've raised some rates, but the projection is, though that may last a little while, the idea being is over time, for a lifetime, the markets reward quite well. What hurts people more than anything else is getting in and out of these market investments. And in fact, just a number of days matter. And ironically, the panic that happened, if I blow up COVID, for example, in 2000, you had some huge down days, down 10% days. And the very next day, the market went up 10%. Well, if you panicked and sold on these down days, and a lot of people did, that's what drove the market down. You then miss this recovery. Well, you do that just a few times, just miss 10 of those best days of the last 20 years. So miss 10 days out of 1,000, almost, out of thousands, you cut your return in half. And so again, you need to make sure that you have allocated portfolios in such a way that you don't have to put yourself in a position to sell. If you're retired and now you're living off of a portfolio, your greatest risk, if you're not panicking out of your investments, is watching how much you take in a withdrawal over time. And what I mean by that is if you're taking a withdrawal rate of about 4 to 5%, historically speaking, your portfolio should last quite a long time. When you start getting north of that, you start running the risk of running out of money. And especially if you add a high withdrawal rate to panicking out of the market, that is that is a life-changing harm that you can do to yourself, that again, our desire is to help avoid that. So to end with, if you would like to talk more with any one of our partners about your own situation or about how this relates to you, by all means, give us a call and reach out. I wanted to basically take 30 minutes and bring some perspective to the markets, to the economy, to history of investing, some principles, and just reiterate that at the end of the day, you either need to pay a lot of attention to your portfolio and your plan and your life, or you probably need to be paying someone to help pay attention for you to try and help you live the best life you can afford. Here at Forum Wealth, we are paid an advisory fee to help manage portfolios and pay attention for clients to help make sure their next car payment or their next automobile purchase, their home improvement, college, retirement, cash flow, paying off debt, all these plans have time frames, have responsibilities assigned to them of who is paying for what, when. And most advisors are paying way too much attention to markets, interest rates, what the Fed's doing, Ukraine war, the headlines, the hot stock, the hot idea, and they're not paying enough attention to what you, the client, actually needs and when you need it. And here at Forum Wealth, we feel we make a difference by making you the person that we focus on, and then we manage the rest for you. So if we can help you do that, let us know. Until next time.